The financial markets are rarely kind to those who ignore their warnings. In the autumn of 2025, they delivered a harsh message to the United States. A staggering $390 billion exodus from U.S. Treasury bonds shook the American economy. This was no ordinary market fluctuation. It was a stark vote of no confidence. For former President Donald Trump, the timing was jarring. This financial earthquake struck as he was laying the groundwork for another run at the White House. The bond market sell-off told a different story. It was a rude awakening for anyone who believed the U.S. economy was immune to reckless policies. This wasn't just about numbers on a screen. This was about the real-world implications for every American, from Main Street to Wall Street. At the heart of this financial drama lay the bond market, that seemingly arcane realm where governments and corporations go to borrow money. U.S. Treasury bonds, long considered a safe haven for investors worldwide, suddenly seemed less secure. As demand for these bonds plummeted, their prices tumbled, and their yields, the effective interest rates they paid, shot up with alarming speed. The benchmark 10-year Treasury yield, a key barometer of investor confidence in the U.S. economy, surged above 4.7%, a level not seen since the dark days of 2024. Longer-term bonds fared even worse, with the 30-year Treasury yield briefly breaching the psychologically significant 5% mark. This was a flashing red light, a clear signal that investors were demanding a much higher premium for the risk of lending money to the U.S. government. The reasons behind this dramatic sell-off were complex and multifaceted, but one factor loomed large: the growing unease among investors about the sustainability of U.S. fiscal policy. Years of soaring budget deficits, fueled by tax cuts and increased spending, had left the U.S. government with a mountain of debt. Now, as the cost of servicing that debt rose sharply, investors began to question whether America's politicians had the stomach for the tough choices needed to put the nation's finances in order. While the bond market sell-off was triggered by a confluence of factors, the economic policies pursued during the Trump presidency cast a long shadow. Trump's signature tax cuts, enacted in 2017, had promised to unleash an era of unprecedented economic growth. But while they delivered a sugar high to the economy in the short term, their long-term impact was more questionable. The tax cuts, heavily skewed towards corporations and wealthy individuals, did little to boost business investment or wages for ordinary Americans. Instead, they blew a massive hole in the federal budget, adding trillions of dollars to the national debt. This fiscal largesse, coupled with Trump's penchant for protectionist trade policies, contributed to a growing sense of unease among investors about the direction of the U.S. economy. The trade war with China, another hallmark of the Trump era, further exacerbated the situation. The tariffs imposed on Chinese goods, while intended to protect American jobs, backfired by raising prices for consumers and disrupting supply chains. This trade conflict, coupled with the uncertainty surrounding Trump's other economic policies, created a climate of volatility and risk aversion that rippled through global markets. The turmoil in the U.S. bond market did not stay confined to American shores. It quickly spread like wildfire through the global financial system, igniting a sell-off in stock markets from Tokyo to London. The interconnectedness of the global economy meant that trouble in one part of the world could quickly infect others. As U.S. bond yields soared, investors began pulling money out of riskier assets, such as stocks, and seeking refuge in the perceived safety of U.S. treasuries. This flight to quality drove up the value of the dollar, making U.S. exports more expensive and further weighing on global growth. The ripple effects were felt most acutely in emerging markets, many of which were already grappling with their own economic challenges. From Asia to Europe, stock markets tumbled as investors reacted to the news from the U.S. Japan's Nikkei index plunged by nearly 4%, while the Euro Stoxx 50, a broad index of European blue-chip stocks, shed more than 3%. The sell-off was a stark reminder that in today's interconnected world, economic shocks can travel across borders with lightning speed, leaving a trail of uncertainty and volatility in their wake. Section 5. The inflation specter rises again. The bond market sell-off was not just a reflection of concerns about U.S. fiscal policy, it was also driven by a resurgence of an old economic bogeyman: inflation. After years of remaining dormant, inflation had begun to rear its ugly head in 2025, fueled by a combination of factors including supply chain disruptions, rising energy prices, and strong consumer demand. The Federal Reserve, the U.S. central bank, had initially dismissed this uptick in inflation as transitory, but as prices continued to rise, it became clear that more aggressive action was needed. The Fed had already begun to raise interest rates in 2024, but the bond market sell-off suggested that these moves were not enough to tame inflation. The specter of inflation was particularly worrisome because it threatened to undermine the recovery from the COVID-19 pandemic, which had already left deep scars on the global economy. Rising prices eroded consumer purchasing power, leading to a decline in living standards for many. This, in turn, risked tipping the economy back into recession, a scenario that policymakers were desperate to avoid. Section 6. Expert Opinions, a Chorus of Concern. The bond market sell-off sent shockwaves through the expert community, with economists and market analysts scrambling to make sense of the turmoil. Many expressed deep concern about the implications for the United States and global economies, warning that the situation could spiral out of control if policymakers failed to act decisively. "This is a clear vote of no confidence in U.S. economic policy," said Nouriel Roubini, a prominent economist known for his often bearish views. "The markets are telling us that they don't believe the U.S. government has a credible plan to address its fiscal challenges or to get inflation under control." Others were more measured in their assessments, but even those who downplayed the immediate risks acknowledged that the situation was serious and warranted close attention. "The bond market sell-off is a wake-up call," said Mohamed El-Arian, a well-respected economist and investor. "It's a reminder that even the world's largest economy is not immune to the laws of economics." Section 7. A Crisis of Confidence. The bond market sell-off was more than just a financial event. It was a symptom of a deeper malaise, a crisis of confidence in the ability of the U.S. government to manage its affairs responsibly. This crisis of confidence had been brewing for years, fueled by political gridlock, partisan bickering, and a growing sense that the American dream was slipping out of reach for many. The Trump presidency, with its chaotic decision-making, disregard for democratic norms, and embrace of populist rhetoric, had exacerbated these trends. While Trump supporters often applauded his willingness to shake up the status quo, his critics argued that he had eroded trust in government and undermined the institutions that had long underpinned American democracy. The bond market sell-off was a stark reminder that economic and political stability are two sides of the same coin. When trust in government erodes, so too does confidence in the economy. And when confidence falters, the consequences can be severe, as the events of 2025 demonstrated all too clearly. Section 8. The Long Shadow of Debt. Looming over this entire drama was the long shadow of debt, not just the national debt of the United States, but the mountain of debt that had accumulated across the global economy in the decades leading up to 2025. This debt, fueled by low interest rates and a seemingly insatiable appetite for borrowing, had created a fragile financial system, one vulnerable to shocks and sudden shifts in sentiment. The bond market sell-off was a stark reminder of this vulnerability. As interest rates rose, the cost of servicing this debt became increasingly burdensome for governments, businesses, and individuals alike. This, in turn, threatened to choke off economic growth, leading to a vicious cycle of debt deflation. The situation was particularly acute in the United States, where the national debt had surpassed $30 trillion, or more than 120% of GDP. This level of debt was unprecedented in peacetime, and raised serious questions about the long-term sustainability of U.S. fiscal policy. The bond market sell-off was a clear warning that investors were becoming increasingly concerned about the risks posed by this mountain of debt. Section 9. A Reckoning for the Global Economy. The bond market sell-off of 2025 was a wake-up call, a stark reminder that the global economy was sailing in uncharted waters. The unprecedented levels of debt, the resurgence of inflation, the lingering effects of the COVID-19 pandemic, and the growing geopolitical tensions all combined to create a highly uncertain outlook. Whether this financial earthquake would prove to be a harbinger of worse to come remained to be seen. But one thing was clear. The old economic playbook, the one that had served the world for decades, was no longer fit for purpose. A new era demanded new thinking, new policies, and a renewed commitment to international cooperation. The bond market sell-off was a stark reminder that the decisions made today would have profound consequences for generations to come. The question was whether world leaders would heed the warning and chart a new course, or whether they would continue down the path of least resistance, risking a future of economic and social upheaval.